Hi guys, welcome back to the channel. My name is Josh, and in this video I'll be talking about whether the New Zealand stock market is overvalued. So in this video I'll go into a bit more detail about what the indicators show us in terms of the New Zealand stock market's valuation, and I'll also talk about what steps you can kind of take. So let's get into the video. Just to give you guys some background, the NZX 50 index has gone up 107% in the past 5 years. So New Zealand stock market has had an incredible run, and 100% over the past 5 years equates to about 15% per year compounded. So each year it's returned 15% on average. And we know that the average return of the NZX 50 is usually about 7 to 8%. So we have done really well above average for the past 5 years. So a lot of people now, they're asking, especially the people who didn't buy stock, they ask, is it a good time to buy stock now? Because they've seen people made so much money and they want a piece of the pie. And then you have people on the other side who bought stock, have made a lot of money, and they're wondering whether they should take the money and run. Okay, so that's the question. Is it time to buy or sell? Okay, so in this video, I'll give you guys a look at the valuation of the New Zealand market, especially the NZX 50, using the following: the PE ratio, market comparables, and the Buffett indicator. So I'll go into a bit more detail later on. We'll also talk about other considerations to be aware of, and then I'll answer, is it time to buy or time to sell? Just a disclaimer, this is not financial advice. If you need help from an authorized financial advisor, do seek help. And if you haven't already, be sure to like and subscribe. So the first indicator that we'll take a look at is the New Zealand market weighted PE ratio, the PE ratio being calculated as the price divided by earnings per share. Okay, and this is a weighted PE ratio, meaning that companies that have a larger market cap have more weighting to this calculation compared to companies that have a smaller market cap. The reason being is that the NZX 50 index usually has a higher weighting on larger companies compared to smaller companies. And this graph here is sourced from Castle Point Fund's article, and they sourced it from Forsyth Barr because data around the NZX index is very hard to find. The PE ratio as at April 19 is 21.6 times. The historical price to earnings is 15.8. So this is the historical average across this period here. So it's about somewhere in the middle, right? 15.8 times. And because it's April, there's a lot of change since April 19. The stock market has gone up significantly. And looking at the PE ratio as at January 2020 from Bloomberg, it's currently sitting at 26.8 times. So the PE ratio has gone like that, right? Because the market has gone up. In the past year, we've returned about 30% on the NZX 50. And so that reflects the much higher price to earnings multiple. And I have this table here as well. This shows us the changes in PE ratio and how it will affect future returns. So this is from the article in the Castle Point Fund's website here. So what this means is that if you don't expect the PE ratio to change, so staying at 0, then this is the return that you expect to receive. So that's the average of 7 to 8%, 7.5 around there. And then if you expect the PE ratio to contract, to decrease, then this is the returns that you'll get after a year in this column: 2 years, 3 years, 4 years, 5 years. Okay, so for example, if you think the PE ratio currently sitting at 26 times is expected to decrease to 20 times over the next year, then that will be about how much it will affect your returns by. So a return negative 20%. Okay, so that is a big drop, and that is something that we might be able to see when a recession comes. Secondly, we'll take a look at the market comparables. This is basically comparing PE ratios with other markets. So I have included here in blue the NASDAQ, which has a PE ratio of 29 times, the NZX 50 sitting at number 2, the S&P 500, which actually has a lower PE ratio than the NZX 50, the Australian 200, the TSX, which is the Canadian stock market, and the MOEX, which is a Russian stock market. So I thought I'd add in the Russian stock market here because you can see how much of a discount emerging markets trade at. 6.77 times compared to what you would consider really good countries to invest in, around the mid-20s on average. And these PE ratios are sourced from Bloomberg as at 17th of January. New Zealand looks relatively expensive when we look compared to markets like the Australian market and the S&P 500. The Nasdaq, on the other hand, has a higher trailing PE ratio, and that makes sense because the Nasdaq is full of tech stocks, and tech stocks usually have higher future expected growth. Sectors really do impact the PE ratios of these markets. So let's take a look at why the NZX 50 is trading at higher PE ratios compared to, big markets like the S&P 500 and the Australian 200. So breaking down the NZX 50, as you can see in this slide, this is from the US indices. More than half of the NZX 50 is made up of healthcare, utilities, and industrials. What I can gather from these three industries is that they usually tend to do well when there is a recession. Because if you think about it, healthcare wise, people still need healthcare, even if, a recession happens. Utilities as well, people need power to basically live. And for example, industrials, they do really well when there is low interest rates because industrials tend to be infrastructure and they have a lot of capital expenditure that they can finance using low interest rates. So they'll benefit a lot from low interest rates. And we can see of the NZX 50, these companies are really Fisher & Paykel Healthcare Limited, Ryman Healthcare, a retirement village. Industrials is Auckland Airport, so infrastructure company there, and utilities are your Meridian Energy and Contact Energy. So these are the companies that are driving a lot of the the movement in the NZX 50 because they make up more than half of the index. So that's why the New Zealand market really trades at high multiples, is because investors really want this sector, and New Zealand is essentially made up of these sectors. And so that's why our P ratio is so high compared to the other markets. Lastly, let's take a look at the Buffett indicator. The Buffett indicator is made famous by Warren Buffett, and this indicator is calculated using total market cap divided by gross domestic product. And from Guru Focus, this is the valuation scale. So anything below 50% is significantly undervalued. Anything between 75 and 90% is fairly valued. And anything above 115% is significantly overvalued. I took the total New Zealand market cap divided by the GDP. Our ratio is 68%. Does this mean that we're modestly undervalued? Well, this is one of the shortfalls of this indicator. So Warren Buffett is based in the US, and the US is a much larger market than New Zealand. So historically, that's the indicator that he used to track how overvalued the US stock market is. Comparatively, in New Zealand, we have a much smaller market. We don't have a lot of companies listed on the stock exchange, so we can't necessarily use the same scale in terms of valuation. But what we can do is we'll take a look at what the US market, the S&P 500, is trading at, and then we'll compare it between the two. And what do you know? The S&P 500 is significantly overvalued, currently at 155%. So if the New Zealand market has a higher PE ratio than the S&P 500, that means that we're also significantly overvalued by this standard, or if not, even more overvalued. Okay, so not very good if you're looking to buy in cheap. This shows us that the New Zealand market is not cheap. Other considerations: why has the stock market gone up so much? Is because of this graph here, the OCR, the official cash rate, essentially their interest rates. And in 2019, interest rates have took a dive from about 1.75% to 1%. So it's been cut quite a few times, cut twice, I think. One here, 0.25, and another one here, 0.5% cut. So when you have low interest rates, your asset prices go up. And I've made a video on this before, so I'll link that in the description. Okay, so what's next? What do we gather from all these indicators? And what I think I see is that the New Zealand market seems to be overvalued when we're looking at, the P ratios, we're looking at comparables, and we're looking at the Buffett indicator. But this may not be the case if interest rates continue to stay low for the long term. And what I mean by that is if interest rates stay low, then your companies like Meridian Energy, Genesis, Auckland Airport that have very steady cash flow will pay out these cash flows, and they usually pay out higher dividends than what you would get at the bank. And so New Zealand has a very high dividend yield, which is why a lot of overseas investors are coming in to buy our stocks. And if interest rates are going to stay low for the next 10, 20, 30 years, our stock market might be a very good deal currently, right? So it depends how you see interest rates going forward into the future. The market currently looks like they believe that interest rates are going to stay low for quite some time. So if you're a passive investor, if you invest in a lot of index funds, then to you, this doesn't matter to you too much because any time is a good time to buy for the passive investor. You should always dollar cost average, which means that you buy consistently. And in the long term, you'll win. You'll win the investing game. You'll do well. You'll do better than not investing because anytime there's a dip, you'll continue buying as well. So as a passive investor, you're just trying to get exposure to the market. In the long term, you'll achieve average returns of about 7 to 8%. So you'll be consistently buying in. To you, this shouldn't matter to you too much, okay? For the active investor though, when you're buying individual stocks, then I think it's a good time to evaluate your portfolio. Take a look at what companies you own, and high quality, reasonably priced companies tend to do well in times of recession. So companies that pay good cash flow, that aren't too overvalued, those are the good companies that you want to hold in times of a recession. And looking back into the global financial crisis, the companies that did the most in terms of price recovery were the companies that could pay out dividends. And one of this example was the port of Tauranga. They've done really well since the last recession. Not saying that you should buy the port of Tauranga right now, but these are the companies that you want to look for when the market goes to trash and everything drops significantly. These are the companies that you want to pick up, okay? And I think these are the companies you want to pick up anytime, even if the market is high or low. These are the reasonably priced companies that have good, consistent cash flows. And yeah, you'll do well no matter what time of the economic cycle we're in. If you're an individual stock picker, there are always going to be opportunities to buy. If you're a passive investor, then dollar cost averaging is always a good strategy to maintain throughout highs and throughout lows, okay? As long as you consistently do that, then you'll do well in the long term. So hope you guys enjoyed this video, and until then, take care.